கனவு. எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும். வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்ன சின்னதா இருந்தாலும் சரி, எஸ்ஐபி உங்க சிரிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும். வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு.
பிங்கியோட காலேஜ் டிகிரிக்காக, பாட்டியோட மருந்து செலவுக்காக, உங்க ஜீனியஸ் தம்பியோட லேப்டாப்காக, உங்க பிறக்க போற குழந்தையோட பொன்னான எதிர்காலத்துக்காக, நாளை உங்க சொந்த ரெஸ்டாரண்ட்டுக்காக, அப்புறம் உங்க ரிட்டையர்மெண்ட்காக, உங்களோட முதல் சொந்த கார்க்காக, பொண்ணோட கல்யாண ஏற்பாடுகள்ல எதுவும் கம்மியா இருக்க கூடாது. வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்காக.
வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்ன சின்னதா இருந்தாலும் சரி, ஒவ்வொரு நாளும் செபிக்கிறோம் உறுதியான நம்பிக்கையோடு. செய்வது நீங்கள் தான், நாங்கள் வெறும் கைதான் கொடுக்கிறோம். எப்படி? எஸ்ஐபியுடன். எஸ்ஐபி அப்படின்னா சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான். சிஸ்டமேட்டிக்னா நீங்க முதலில் இருந்தே சிறுக சிறுக சேமிக்கலாம். விதிகளுக்கு உட்பட்டு விரைவாக அல்லது தாமதமாக நம் ஒவ்வொரு கனவையும் நினைவாக்கும் இலக்கை நோக்கி கொண்டு செல்கிறது. நீங்கள் சிறுக சிறுக சேமிச்சத ஒரு சேமிப்பு பையில போட்டு வைங்க. அப்புறம் ஒவ்வொரு மாதமும் மியூச்சுவல் ஃபண்டோட எஸ்ஐபியில போடுங்க. எஸ்ஐபி உங்க சேமிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் அதன் இலக்கை நோக்கி இன்னும் சீக்கிரமாக கொண்டு செல்லும். ஏனென்றால் நாங்கள் உங்களிடம் தான் பெற்றுக்கொண்டோம். ஒவ்வொரு துளியாக சேர்த்துதான் கடலை உருவாக்கலாம் என்றோம். இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும். வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்ன சின்னதா இருந்தாலும் சரி, எஸ்ஐபி உங்க சிரிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும். வாழ்க்கையின்
இது பிங்கியோட காலேஜ் டிகிரிக்காக, பாட்டியோட மருந்து செலவுக்காக, உங்க ஜீனியஸ் தம்பியோட லேப்டாப்காக, உங்க பிறக்க போற குழந்தையோட பொன்னான எதிர்காலத்துக்காக, நாளை உங்க சொந்த ரெஸ்டாரண்ட்டுக்காக, அப்புறம் உங்க ரிட்டையர்மெண்ட்காக, உங்களோட முதல் சொந்த கார்க்காக, பொண்ணோட கல்யாண ஏற்பாடுகள்ல எதுவும் கம்மியா இருக்க கூடாது. வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்காக.
வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்ன சின்னதா இருந்தாலும் சரி, ஒவ்வொரு நாளும் செபிக்கிறோம் உறுதியான நம்பிக்கையோடு. செய்வது நீங்கள் தான், நாங்கள் வெறும் கைதான் கொடுக்கிறோம். எப்படி? எஸ்ஐபியுடன். எஸ்ஐபி அப்படின்னா சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான். சிஸ்டமேட்டிக்னா நீங்க முதலில் இருந்தே சிறுக சிறுக சேமிக்கலாம். விதிகளுக்கு உட்பட்டு விரைவாக அல்லது தாமதமாக நம் ஒவ்வொரு கனவையும் நினைவாக்கும் இலக்கை நோக்கி கொண்டு செல்கிறது. நீங்கள் சிறுக சிறுக சேமிச்சத ஒரு சேமிப்பு பையில போட்டு வைங்க. அப்புறம் ஒவ்வொரு மாதமும் மியூச்சுவல் ஃபண்டோட எஸ்ஐபியில போடுங்க. எஸ்ஐபி உங்க சேமிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் அதன் இலக்கை நோக்கி இன்னும் சீக்கிரமாக கொண்டு செல்லும். ஏனென்றால் நாங்கள் உங்களிடம் தான் பெற்றுக்கொண்டோம். ஒவ்வொரு துளியாக சேர்த்துதான் கடலை உருவாக்கலாம் என்றோம். இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும். வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்னதா இருந்தாலும் சரி. எஸ்ஐபி உங்க சிரிப்போ உங்களுடைய வேலைக்காக உங்கள் ஒவ்வொரு கனவையும் இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும்
இது பிங்கியோட காலேஜ் டிகிரிக்காக. பாட்டியோட மருந்து செலவுக்காக. உங்க ஜீனியஸ் தம்பியோட லேப்டாப்காக. உங்க பிறக்க போற குழந்தையோட பொன்னான எதிர்காலத்துக்காக.
Take their seats. The program is about to begin. Good evening and a very warm welcome to the Hindu Businessline's bl.portfolio Investor Conclave, an exclusive summit brought to you by LIC Mutual Fund. I am Parvatha Vardhini, the editor of bl.portfolio. This conclave is meant for those seeking investment avenues for various financial goals, and the audience can engage in discussion with the expert panelists who will address the conclave. Importantly, this event in Coimbatore is only the first in a series of investor conclaves planned in prominent centers in the southern states by bl.portfolio in association with LIC Mutual Fund. To welcome our esteemed invitees and guests to this inaugural meet, I call upon Mr. Ravi Saraogi, editor Businessline, and also request him to share a few words with our guests on the newspaper and its offerings.
Good evening, Malai Vanakkam. It's nice to be in this city coming from Chennai. You know, it's so cool and breezy and compared to the sweltering heat in Chennai. And I discovered that my friends from LIC Mutual Fund from Bombay are also very happy to be here because Bombay is equally sweltering. So thank you all for coming to this first, as Vardhini said, first of a series of events, bl.portfolio Investors Conclave, brought to you by LIC Mutual Fund, our partner. We will have the next couple of hours. It'll give you an insight into retirement planning, how to invest, what are the best avenues, what are the pitfalls that you should watch out for, and hopefully when you go back, you'll go back enriched with a little more knowledge about retirement planning. Businessline, as you know, is 3 decades old and a little more than that, 31 years. And I'm a lifer at Businessline. I joined Businessline when it was being planned back in 1993. We began first publication in 1994. And today I'm particularly proud to be at this event because I cut my teeth as a research analyst in the Businessline Research Bureau. And I spent the first 7 years of my journalism career in the Businessline Research Bureau, writing for the portfolio's earlier avatar called Investment World. We started publication of Investment World in the end of January 1994, Jan 28, 1994 to be precise. And I was one of those involved in the planning of the product and the launching of Investment World, which became a very successful product within the first few months of its launch. And it used to come out on Sundays. And portfolios now, the new avatar, new age, you have to change with the times. You can't keep sticking to the old names and old concepts. So portfolio is a new avatar of Investment World. The Research Bureau of Businessline is pretty much its core. It's staffed by wealth of experience and knowledge. We have chartered accountants, we have CFAs, we have MBAs in finance as part of the Research Bureau. And these are all analysts tracking particular sectors and specializing in them for writing about stocks, mutual funds, personal finance. We have a good technical analysis team here. And we do a lot of technical analysis on not just stocks, on indices, on commodities and stuff. We cover a broad spectrum of assets, asset classes, and we do, as I said, fundamental and technical analysis. We do IPO recommendations, IPO analysis, mutual fund recommendations, NFO reviews, personal tax, insurance, personal finance, bonds, FDs, the works, everything that's required in the field of investment. We provide content unlike others that is actionable. We give clear buy, sell, hold calls, and this is across asset classes, equity, debt, gold, and other commodities. When we last took stock of ourselves at the beginning of this year, we discovered that 63% of our buy and subscribe calls had delivered market-beating returns. And about 41% of our accumulate calls also outperformed the Nifty 50 index. We keep up with emerging trends, derivatives, international investing. We give recommendations on investments in stocks listed on the NASDAQ and NYSE. We started this about 4 years ago when the international investing started off in a big way. We also do regular videos and podcasts on market outlook, technical analysis, stock picks, and podcasts with market experts. We have our own, this is again a first for Businessline, for any financial newspaper in this country for that matter. We have our own internal ratings for mutual funds. It's called bl.portfolio Star Track, which follows a robust assessing methodology that is devised by professionals. And we rate equity, debt, and hybrid funds. Our Take 500 section on financial performance and market performance of the top 500 stocks by market capitalization has a wide following, and I can attest to that. There are times when we have had to drop that section to accommodate something else, and the next day I would get a flurry of calls, and there'd be angry emails saying, why did you stop that section this week? So we make sure whatever else we drop, we don't drop the Take 500. We engage with readers. It's not a one-way communication. We engage with readers apart from through these kind of meetings. Through our columns, we call for queries, and experts on tax, personal tax, insurance, mutual funds, and derivatives answer the queries of readers. And we publish these in the newspaper itself. And the best part of all this is that you get it for just 12 rupees every Sunday. It is one of the cheapest investment advisory products available in this country. And we have a long track record, as I said. We have seen several market cycles in the last 30 years, bull markets, bear markets, crashes, you name it. And there's a wealth of institutional knowledge that is resident in the newspaper. I would urge you all, if you're not subscribers, to try our product on Sundays and benefit from it. So thank you once again for coming here. I don't want to take up too much of the time because there is a lot of interesting sessions scheduled in the next couple of hours. Please stay on and benefit from it, and good luck. Thank you.
Thank you, Raghu. I now invite Mr. Vasudevan Desikachari, Zonal Head South, LIC Mutual Fund, for the presentation on investment awareness, part of the investor education initiative by LIC Mutual Fund.
Good evening, everybody. Thank you, Parvatha Vardhini, for your invite, and I should first thank Sir for your esteemed presence here, for the first of its kind here, and all the esteemed guests, Aarti Sir and Bhansali Sir. We know it for years now, so thank you all. I would like to thank everyone in this auditorium where you all have taken time to come here and to be a part of the growth, what we see in as an investor, what the mutual fund industry is going through, and you will be part of it. How many of us always say, see, nobody feels like, should I talk about money? Because everybody likes money. Money is something which is something we'll, as soon as you say, acha money, so the eyes starts glowing. So what we do with money is, many times, the first one, we always want to save, but I don't know how many of us do it in right way. That's second. Spend. The best thing which we like is, as soon as we get money, it's okay, I have to find a way to spend. So if I ask the next generation who is in the, I think, second side of this crowd, first thing, I have to go for a job. As soon as I go for a job, I want to buy a bike, I want to buy this, I want, but so spending is something which is destinated. And this is the last one, which is something beautiful, which actually gives you both of this. When you start doing it right from the childhood or from the start, you will have the spending till your last breath. Because if you make an investment wisely and create your value for whatever you did, and you can grow your wealth, and at the same time you can ensure at all time you don't miss out on any spending which you want. So I'll just go through this set of slides. Some of the important points I would like to take more time. See, this is how many of you know Mr. Warren Buffett is one of the best. I would say, if anybody wants to quote saying that I want to become a great investor and make huge money, his name comes first, because a very seasoned man who has invested a lot in, he just said, don't save only for spending. Actually, you save, then you do spending. Because many times what happens, as soon as money comes, I always spend, and then whatever balance I will try to save. Always if you ask somebody how much money you want to save, they'll say monthly I got only 30,000 rupees salary, out of which I have 28,000 rupees expense, and 2,000 rupees only I have, what should I save? This is what they say. Instead, monthly I want to save 10,000 rupees, within the 20,000 rupees I spend, if you start doing it, you really create a wealth for you. Those who have created wealth, or those who are wealthy today, have done the other way. That is the reason. That's what Warren Buffett said. How many of you know this name, inflation? You keep knowing, because many times we see RBI governor talks, finance minister talks, somebody talks, anybody talks about inflation. Do you know how much it eats away your money? We have put aptly the apple pie. There are different ages of crowd here. I'll give you a very slighting example in inflation. Somebody who was in 1980s, 84, 85, can anybody at the young age, I don't want the old age people because they would have done this, they would have seen this. What is the rate of a gram of gold or a sovereign of gold in 1983, 84? Can anybody guess? Just one guess. Sir, You would have even bought also, sir. I want somebody in the younger age. Okay, sir, you tell so that the younger gets enlightened. No, sir. Still, it was much lower. Somebody said, right? It was close to around 450, 500 rupees in somewhere around 1983, 84. 1 sovereign of gold. Now you can't get a gold paint also for this rate. Remember one thing. It is, I'm not telling you for the sake of, it is like if the same period somebody had 500 rupees, that day there was no 500 rupees note, 500 rupees note, keep that note, hopefully without any demonetization it is still there. That 500 rupees, can you buy anything today? Nothing. What happens? Your money which is not invested in actual good right assets doesn't earn you anything, because if you keep it as cash or if it is not earning this one, inflation eats away this money in some form. So what you need to do is, whenever you have money, you should see that whether your money is earning more than the inflation which is called. Today, can anybody say what is the inflation in the country? 6%. The government talks about 6%. Actually, if you ask individually, you will say, okay, 8%, 10% is actual inflation in various commodities and various things. But fact remains, if I have the money not working above 6%, actually speaking, I am getting negative returns. My money is negative, it is not positive. But if I get 6% also, what I will say, if I put 10,000 rupees, I will get 600 rupees in the end of the year. But it doesn't make sense, because your value of the 10,600 rupees after 1 year is only 10,000 rupees again. It has not moved. So that is what inflation is all about. I just wanted to give you an idea with an example. So what happens, the impact of inflation, if you see, most of the time, if 5% inflation is there, if you invest, actually speaking, you don't lose out on money. This is what I gave it as a different example there. What we do to solve this, what you need to do is start investing in instruments which can beat inflation and start earning your capacity. Earning capacity, you have to see, anybody is today working for an organization. First you will say, sir, yearly, this year, how much you got increment? They'll say, okay, I got 6%. Okay, sir, at least you give me inflation beating increment. This is what they'll say. What it means is, last year I got this salary, next year I want a salary which will be at least equivalent to the plus inflation I should get. So that is what happens in our investment also. You should look at this slowly, it has to start progressing, and you should put your money in assets which will give you the benefits of compounding also. What happens when you have an investment which is giving slightly more than inflation? It starts compounding, and automatically your actual returns will be slightly higher than the inflation, so that your net of inflation, you have a positive money in your hand. What is called financial planning? See, since I hail from this industry almost close to around 28 years in same industry, what happens, many of, and I think Aarti would have also heard a lot of people coming to them, Bhansali sir is there. I have seen many of you who have been handling financial planning. Many of them start thinking about financial planning at an age when they are actually 5-8 years before retirement. They will start thinking, oh, what will I do after next 5 years, 8 years when I retire? Frankly speaking, this is a beautiful ladder. Although the ladder says a lot of things, what you need to look at is your financial planning has to start at a very early age, because it is easier to plan when you start at an earlier age. The ladder will be slanting and you can actually achieve your goals much easier. But many times it is not too late for a person. It's better not too late, at least start somewhere. Definitely the financial planning for the second lot of people who are sitting behind, I would suggest, as soon as you get into an organization, start earning, please start planning your financial planning, start putting some money in investment, so that you will have a fabulous life in the later part of your career. So, as I said, the financial planning, you have to do it necessarily, because when we go by, once we cross 30, we start feeling, oh, I got married, I have a kid, what I will do for this kid, I have to save. One beautiful thing in Indian system, you have the earlier ages, what has happened, we had varieties of financial planning available, but they didn't know what to do. What they started doing is, as soon as the child is born, they will put 2 grams gold what is it, they give a small stud, they will give one chain. They started investing as a gold. Actually speaking, our forefathers have done excellent financial planning. They gave gold. What are the two things which they have invested earlier? It was gold and land. You financial tangible assets have come to fray after 1980s, if I would say more of lot of things. So now I would still say lot of people have started looking at this as a tangible financial planning, because we have been financial plan. I used to take classes for some of the colleges. I would say the youngest guys in our house, many of us would have played a game called what is a business or anything. That's a beautiful financial planning game which we used to play before 15. But once we cross 18, we forget the whole thing. We buy land, we build house, we take rent, we do pay tax, everything we have commuted, we manage that. That's something which is very important, which you have to start preparing yourself once you start getting your income. Please remember, your salary is something which you know you will get so much. So never depend on a single income. Always ensure that there is something, a second income in your hand through financial planning. That means I'm not saying you have to work for two places. Whatever money in your hand has to work for you as the second income for you. It should create an extra wealth which will give you second income down the line, which can create a lot of assets for you. Now you have to see where we have to invest in the long term. Because young age, when we start financial planning, we will be investing for 20-25 years. Somebody is at 25, minimum they will invest for another 35 years till 60 when they work. So what you need to do is how the market actually has reacted in a long term. What will be the returns that you generate through the markets? See, how many of you know about the markets, equity markets? Just idea. Those who are younger, please, I would request all of you to have a view on the equity markets, because equity market is nothing but India's growth story. Please remember, whatever is seen in equity market is what is India's growth story, past as well as what you are going to see in future. So what has happened in equity markets for 5 years, 10 years, 15 years, up to 40 years, this particular instrument has given a return of close to 15% year on year. That is CAGR, what we call. So it has, if you see, when you invest for a really long term, you really make a fabulous return, and it gives you a long term benefits. Because always when you invest for, see how many of, if you buy a land, you buy for at least 25-30 years. When you buy a gold, you buy for ever. Many of them don't even sell. If they sell, they will buy another. When it is same is the case, which you have to look at for equity markets and even mutual funds which is affiliated to that. Always do your financial planning based on goals. Simple, sir. The people who are old, you know very well. My son is now on 6th standard. After 15 years, he will be in engineering college. I have to spend 5 lakhs. At 15 lakhs. Today, I think 5 lakhs, nobody will get even seat also. No fees will be there. At least 15-20 lakhs you should have for an engineering college. That 15-20 lakhs on the day of the child being at 18, it is very difficult for a father to actually generate that money that day. Then what happens? You go to a bank to borrow education loan, all these things. But instead, if you plan it when the child is at 5 years and 8 years and create a wealth, that is called goal-based planning. You want to buy a car. I think you must have seen all these TV ads of mutual funds. If you want to buy a car, this car is not costly. If you start investing now and in SIP, you can accumulate wealth. So you should create a goal, because not only in financial, personally also, we look at goal as a main process by which I want to become a doctor, I want to become an engineer. There is a goal place. Even in financial planning, you have to go by the goal place. What are all the various options is there? I told you, this gold, actually property, this is something which is years together our forefathers have actually used as a financial planning. What you need to look at is stocks, insurance. These are all the main things which is already there. Everybody takes insurance. I would still say, I am a mutual fund guy, I will tell all of you, please take insurance in your name. Insurance is essential. It is the most important thing, because when we buy a bike, I used to say that, can we drive a bike without an insurance? No. The same is the case, is because we are much valuable than bike. So we should have insurance. Same is the case. We should start investing in mutual funds instead of stocks, because stock market is slightly complicated where you will have the market's movement as you cannot track. But mutual funds is a place where the market movements are tracked by fund managers who are experienced in it and give you the best of the returns based on the market value. So what investments you should do? You have to do inflation fighting, provide income, okay, because many times at a later age you require income, accessible and useful portion, grow value, appreciate, realize value and cost. This is what I said, we should do investment for various things at various levels. That is called asset allocation. What you have to put some money for 3 years, some money for 8 years, some money for 15 years. So that is basically called asset allocation. If you say in a shorter duration, everybody keeps it in bank account because I need money immediately. Some you need to keep it in gold. This is basically an asset allocation. Mutual fund is one platform which gives you a common space, investing in many of them in a debt market as well as equity market and even gold. It gives a common platform for you in asset allocation. What is mutual fund? It's just simple. A mutual fund is a trust created to collect the money from everybody. I don't want to use certain things. If a particular company stock is valued at 1,000 rupees or 10,000 rupees, but a person who is investing has only 5,000 rupees, he cannot buy that stock. What happens? Mutual fund collect money from everybody and pool that account into a single amount, and that they invest in various stocks according to the portfolio designated. So it gives you an idea. Many of you are in Tamil, I can give you. இங்கே ஒரு பர்த்டே இருந்ததுன்னா ஒருத்தருக்கு பர்த்டே இருந்ததுன்னா இத்தனை பேருக்கு ட்ரீட் கொடுக்கறது ரொம்ப கஷ்டம். ஓகே, எல்லாருக்கும் இதிலே 10 பேருக்கு பர்த்டே இருந்தால் the treat amount is distributed at the same time, everybody is happy that treat is done. Mutual fund does similarly this, because your risk is reduced, at the same time the benefits are got, everybody gets the same benefits together. So mutual fund is a vehicle which collects money from everything, invest in market, get the return and distribute the return to all the investors in the same mutual fund. So it is a very important vehicle which is going to be the future of the world market. In fact, today the worldwide mutual fund is very big. India is growing at a very rapid speed. I would say all of you just have a look at it. As I said, they pool the money, give the fund manager invest in stocks, they collect the returns and return back to the investors. Why I have to take mutual fund? Obviously, I will have a professional management, I have a transparency, I understand that I have liquidity. Anybody wants to withdraw the money, it can be done faster. What are all the categories which is there? I thought it will not be apt to spend much time here, because there is a sponsor, there is a trustee, investors come and asset management manages the funds and gives back to you. Mutual fund has two types of schemes. Earlier we used to have a closed-ended fund. Predominantly now it is more of open-ended funds, which we see that. There is two categories, closed-ended fund and open-ended funds and interval funds. I would still suggest at an earlier age, when you are starting an investment in mutual funds, open-ended funds are an ideal one which has liquidity as well as the time frame. Closed-ended funds are for designated returns. For example, I have exactly 5 years, I want to invest for 5 years, I don't want to touch, get into closed-ended funds. So in investment objective, it is a growth oriented or income oriented. What we see is income oriented. There could be somebody who doesn't want to, he is getting his retirement money, he wants to keep it safe, but at the same time he wants to generate slightly higher returns. He get into a debt oriented funds, and you have both debt and equity combined hybrid funds, which are all there. Yeah. Interval funds are the funds which always has, it opens for a particular type of interval. It will be only for a particular interval. For example, every month 1 to 3rd, this fund will be open. After that, again it will close. So it is a type of a closed-ended fund with an interval opening of a specific dates. Interval funds will be there. It was part of the mutual fund for a quite long time. Slowly it is faded out, because what happens, only during that fund the investment comes in, again it is closed. So it became, with the regulations in a different scenario, it becomes difficult for the investor also. Liquidity is cramped for the 27 days or 93 days or whatever it is. So interval funds started fading. So equity schemes, debt schemes invest only in debt-oriented investments. Equity invest, that hybrid will invest both. And you have retirement-oriented, which I think I would request, anyway, we have a session which is going on retirement planning, so that they will cover, which will be creating solutions for retirement. And there are funds which will traded in exchanges. I'll do it. So in equity schemes, I would say this is clearly designated with the equity markets in stock exchanges, where we will see the growth of the companies and other things, which based on that, the investments will be done. Anybody who is having a long-term view would like to invest, this is be an ideal one, because you get, according to the growth of the country, you will make money in this, you will get good returns out of this fund. So we have various category, a large cap fund, mid cap fund, large and mid cap fund, small cap, based on the market capitalization of the stocks which is getting invested. And mixture of this, multi-cap will be mixture of this, flexi-cap will be mixture of this. There will be some certain thematic schemes which will come, dividend yield, or these are all also the various categories which comes in. And equity-linked savings scheme is a scheme which invests only in schemes where you get a tax rebate. Today, 80CCC is there. Those who want to invest, it will be a 3-year lock-in fund. Debt schemes invest in only debt-oriented securities, which will be, which will always give a, see, when you take a equity, you take a long-term view and you get higher returns. Debt will give slightly lower returns, because today you all know what is the average return of an FD for 3 years or 1 year. That's, to that range it will be given. It will be investing in government securities, various different types of securities. As I said, there is various categories of debt funds which is there. In that, the lowest 1 day money also somebody can invest. Liquid fund 7 days, various periods, how long you want to invest. Depending on that, various categories of funds are there. This is again similar one. Again, this is again, it is a purely debt. Both put together is called hybrid. Hybrid also you will have, which will, see, the intention of hybrid is, when I grow old, when I reach 60, 65, I always feel I don't want to take so much equity risk, but at the same time I want to beat the inflation. So you merge both debt and equity. Again, I'm telling you, even the retired people should have an exposure to equity, because what petrol cost is for me, what petrol cost for an youngster is the same petrol cost for a retired person. So the inflation will hit everybody. Everybody should have a portion of money. Even the government NPS system also has 25% minimum equity at the later age. So you should have equity as an exposure, but debt will be more when the age grows. So you will have a lot of hybrid funds category depending on the percentage of equity and debt allocation. Solution-oriented schemes, retirement, the young children till the age of their maturity, 18 years, there are a lot of funds which will come. Fund of funds is basically a funds which invest in other funds and generate return instead of investing directly into the market. It can be overseas also. Somebody wants to invest in China, US, that also can be done through fund of fund. So index fund is a peculiar fund which just reflect the index. So if you think that India is growing, but I don't want to take around individual stocks, but I want to invest, index funds help you in generating actual index-based returns. It may not give extra returns because of the stocks movement. You have various types of index. It mirrors the index and you give the return. ETFs, it is all, most of them are index funds which is launched. Yeah, which is launched in the, and it will actually get traded only in stock exchanges. You cannot directly buy from the fund houses. For the initial public offering, you can buy it from them. Gold fund, it invests in gold. See, many times we go to the gold shop and we buy gold and keep it for long term. But just I will take 1 minute on this, because this is a very important fund many of us don't actually look at. Sir, we buy gold at the age of 6 or 7 for the kid with some chain. The same child after 16 or 17, they don't like it. When they get married, they will say that this model is not light, I don't want. And what happens end of the day, that gold jewelry you have to again put it into gold shop, again buy, and Whenever you sell a gold and buy gold, actually gold jewelry makes big money. Whereas if you are sure that this is kept for the child's marriage, you can invest in gold fund and get the same gold related returns. And when the child is going for a marriage, you redeem from this and put the money in gold and buy the actual asset which you want. But nothing can replace what you use it. If you usable gold, please buy it and use it. There is no change in that. So international fund, I said it can be invested in various international markets. Fund of funds will invest in. The arbitrage fund is basically a slightly higher end of an equity fund where I buy in cash market and sell in F&O market. So as I said, these are all the things. As per the organization, we need to have all these things. Any mutual fund will have all these things. When you are investing, you are supposed to actually read scheme related documents, because you should know what risk I am taking to take this return. That is something which you need to do. If you see any of your ads, you should actually read scheme offer related, whatever Dhoni advertisement or any advertisement which is coming, you will say that, you will see that words. The fact sheet is published by the organization every month. You can go through where your money, this is what transparency is all about. You can read that. Various plans you can invest in regular as well as direct. Growth option, you can withdraw money monthly, you can do that. You can take it as accumulation, distribution, withdrawal, as well as you can keep it as cumulative also, which we call as growth. You can do monthly investment, you can do bulk investment, you can do one scheme to another scheme, everything is possible. Systematic investment plan is very, very important for everybody. Please, as a person, don't miss out on, at least you should have 3,000 to 5,000 rupees of minimum systematic investment plan. So, because this is one which will give you the power of compounding. This is going to be, if you do an investment for 25 years, the monthly, we have just put 1,000 rupees monthly. For the amount we have invested is 4,20,000 rupees. In 25 years, that will grow to close to around 23 lakhs. No, the amount of compounding will work big time in this. With an 8% return, we have not calculated this with a higher return also. So, how rupee cost averaging works? You put 10,000 rupees monthly, every month. In the falling market also, you continue to put the same amount, so you get more units, the returns will be high. Systematic, the old people, somebody who wants monthly some payout, you invest, they get the return, they can withdraw systematically every month for their monthly expenses. How to invest in mutual fund? Basically, everybody has to do a know your client, which is essential for every instrument in India today. You will complete that formalities, fill the applications, and then you can now, this can be done even in online KYCs. Now KYCs are in online. You can do in both physical and online mode. You can withdraw money. The very important thing is, whatever you invest, if it is not liquidatable when you require, it doesn't make sense. So this is very important thing which you will get available for liquidation anytime. You know the value of your assets, number of units you know, just multiply with the net asset value, which is declared every day night for every scheme. And you will know what is the risk which you are taking based on this riskometer. You can do your nomination, and it is essential today. You have to definitely do nomination and complaint. I wish there will not be much complaint, so you don't need to worry. Invest. So SEBI has this process. Taxation. Mutual funds are considered as a very tax efficient manner, which they give you fantastic returns. So please use it. I would not take much of your time. Thank you. Thanks a lot.
Thank you, Mr. Vasudevan. I'm sure that the audience, the young audience at the back there who did not have an introduction to mutual fund earlier, got to know quite a few things about the product. So retire with confidence is the theme around which today's event is centered, and we are just going to get into that theme. As a curtain raiser for the panel discussion, I thought I could put a few points forward to all of you, which I'm sure the panel will, discuss in greater detail. So I titled it "Retirement Planning Isn't Easy." So why? Why is it so? Because okay, so there are so many other moving parts in retirement. It's not only about, one amount that you can think of. So it is also about, as Mr. Vasudevan told us elaborately, inflation and expenses. So today, if you start saving for retirement, you can't say today's expenses will be the same 35 years later. So that is one kind of inflation. The other inflation is post-retirement. Say you live from 60 until 90. So what happens to the inflation then when you have to withdraw from your retirement corpus? That is the other kind of inflation. Then how many years to retirement you have? So if you're 25, you have 35 years, but if you're 50, you have only probably 10 years if you want to retire at 60. How many years of retired life you need to provide for, which I just told you. So if you have a very long life ahead, I mean, it's good in a way. It may not be so good if you fall short of your corpus. And of course, these days, caregiving, especially after COVID, we've seen that a lot of medical expenses are involved. Home care, a lot of senior citizens need continuous home care, and which doesn't come very cheap. So there are a lot of things to provide for when it comes to retirement. It's not a very simple thing like thinking, as I've written on top, 1 crore. Yeah, I need 1 crore. It's a fancy number. Let me have it for retirement. And then say, I'll put in an FD which will give you 8% returns. I get 8 lakhs every year and I'm happy. So it's not such a simple thing. This is, again, what Mr. Vasudevan told us about. So how expenses can move. So, if today you're spending, say, 6 lakhs annually, so, the same 6 lakhs will be equal to 35 lakhs almost after 30 years. So you have to provide for this sum. So this is how you plan your savings, taking into account inflation. So here we have assumed an inflation of 6%. And the other factor, as I told you, in the moving parts is also on the longevity side. So if you see on top, there are a few pointers. So as I said today, we all see in our own homes, we have senior citizens, we have our parents, grandparents who are all, living till 85, 90 thanks to, improving quality of life and improving quality of medical care. So while life expectancy at birth for India is 69.4 years, at 60 years it looks much higher at 77.5 for men and 79 years for women. See, women are also outliving men. That is an important thing. So women who don't have a direct source of income need to plan for something, or the spouses need to provide for women, considering a longer life for them. And there is a lot of variation within India also. So Tamil Nadu is considered a very advanced state, and here the longevity is much more than probably the other states. So a lot of variations, and it could be a regional thing also. So when it comes to retirement planning. So why we need to keep, all these, why does longevity matter is the same thing which we discussed earlier. So because, there is inflation to account for, and see, as we all know, you read in the papers that the inflation for the last month is 5%, 6% and all that, but your own personal inflation may not be the same. Because in the official inflation which the government puts out, food, for example, will have a 40-45% weightage, whereas in your own expenses, at one point in time, you have a child entering a college, or you have a senior to provide elder care for, your medical or your educational expenses, which will be much more on a monthly or an annual basis. So then, if medical or education, you read in many places, many surveys tell us that, sometimes it touches early double digits, the inflation in medical and education expenses. So your own personal inflation may not be the CPI 5% or 6%, which the government is telling you. It depends on what life stage, your lifestyle, and what kind of expenses you are incurring on a recurring basis. So the other fact is also that even if you have health insurance, when you're more advanced in age, medications and all that may not be covered, and you may require assisted living. So these are all the factors. So to consider when planning for retirement, if you expect a long life ahead. And this is, obviously, you not only need to provide for inflation when saving for retirement, but also provide for inflation when actually, withdrawing from the corpus. So the corpus needs to be such that, the corpus has to outlive you. So, you can't fall short of the corpus. So this is how expenses at 60, if you live till 70, a 6 lakh at age 60 will become 10.7 lakhs. But if you live till 90, 6 lakhs that you spend at age 60 will be the equivalent will be 34.5 lakhs. So this is the other side of inflation beyond retirement. And of course, why healthcare is a challenge. So recently, I think the insurance regulator came out and said, there's nothing like health insurance policies can't be given after age 65 or after a certain age. And anybody is eligible for healthcare policies, even if they are senior citizens. But even assuming you do go and get a policy at that age, there are a lot of, all of us know we don't get our claims in full because a lot of coverages may not be available and may not be accepted. And premiums also go up very sharply. So recently, Businessline itself, we had anecdotal stories telling us that every year, the premiums are increasing such that in over 3-4 years, the premium has almost gone up by 50%. So, and of course, outpatient kind of care like, mental or neurological conditions, home treatments, all of this, a lot of it we saw during COVID, all this is not covered by insurance. And nursing, all of us know, is very, very expensive. If you want to have a 24/7 nursing setup in the house for yourself when you grow old, so it becomes a problem. So that brings us to, accounting for inflation, accounting for healthcare, accounting for longevity, and all that. So how do you get the right corpus? So to get the right corpus, you need to know your safe withdrawal rate. We have Mr. Ravi Saraogi here in the panel who will be joining us next. So, he has done extensive research on safe withdrawal rates. So safe withdrawal rates is nothing but at, say, age 60, you have a corpus of 10 crores. How much should you withdraw every year such that your corpus outlives you? So that is a big calculation. So as I had, said initially, it isn't easy. So it needs to be approached very scientifically. The withdrawal rate is not something where, say, after 60, you put in an FD, it gives you 7%, so you think you can withdraw 7%? No, it may not be right. You put it in a debt fund, it may give you 5-6%. Is your withdrawal rate 5-6% then? No, it may not be 5-6%. It is something else. So it is a proportion you can withdraw so that your corpus outlives you. And all the factors which we have been discussing, all that needs to be considered. So ultimately, what is the action plan? So how should you actually go about planning your retirement corpus? So this, I'm sure the panel will discuss extensively, but this is just a bird's eye view. So today, what is your expenses? So say you have a 10 lakh per annum expenses or whatever according to your life stage. So you have to estimate what this living expenses will be post-retirement at today's prices, and then arrive at the inflation calculation. So as I said, we have a standard number, 6% or so, which we apply, generally financial planners apply, but it can be arrived at scientifically. Do that and then arrive at a target corpus. So what will be your target corpus based on what you want to spend? What will be your monthly expenses post-retirement and, accounting for inflation? So with that target corpus, then you use a safe withdrawal rate to arrive at the target corpus, then decide on the asset allocation. Mr. Vasudevan told us about asset allocation. So how, you invest to arrive at the target corpus. So what kind of funds will you invest in? Will you use any other products? That is another thing which you have to think of. And then you decide. So you want to retire at 60, 65, how old are you now? And then you start SIPs in funds. Mutual funds, which we are going to discuss in great detail, how to use mutual funds. You can use them to, set up your retirement corpus. And then very important is rebalancing and reviewing. So it's not that, at 25 you decide to invest in a set of funds or a set of products and then it goes on and on and on. You do a review at regular intervals and closer to your goal. say 5 years down the line, 5 years earlier to retirement, or 7-8 years earlier to retirement, you start thinking, should everything be only in equity? Can I move a little bit to debt to make it safer? So that is called rebalancing. So closer to the goal, you should always rebalance to preserve whatever gains you have made. And then the withdrawals, if you've done your investments in mutual funds, you start withdrawals you do your investments using SIPs or SIPs, and you do the withdrawals using SWPs or systematic withdrawal plans. So that was just a quick putting together of facts which will probably be discussed in greater detail in the panel. I just thought I had, probably could raise these few questions which the panel can take it up. So one thing which I was speaking of earlier is calculating personal inflation. So how much of, would you always go by the 5-6% official inflation number, or would you want to calculate a personal inflation number with your financial planner when you arrive at your retirement corpus? And of course, I was talking to Mr. Ravi Saraogi this morning on the flight, and we had this discussion about, are people going to really stop earning at 60? May not be. These days, all of us are very, well qualified and really highly skilled. So probably we'll take up some gigs. I have a guitar there, but I don't mean everybody is going to be a musician. But would you be taking up some gigs, or would you be doing some kind of work in some form, which will always keep giving you some income? Then, you probably can manage a little better. You don't have to entirely depend on the corpus. You will still be getting some inflows, maybe that. And the other factor is also taxation. So even when reviewing your funds, like every few years, if you want to move out and all that, you always have to keep taxation, the amount that will go to the exchequer, in mind, because that is not the sum which is going to add to your corpus. It is going to go out. It's an outflow. Rebalancing. Also, when you do rebalancing, withdrawing, at every stage you have to keep taxation in mind. So, and the other thing is also the effectiveness of thumb rules. We always say, 25 times your income, 30 times that, 5 times this. These kind of thumb rules, if you Google, you will always get. So these are a few other points I thought the panel can probably take it forward and, discuss in greater detail. So yeah, that was a short curtain raiser to the panel discussion. And I think we can move forward with calling the panelists and the moderator on stage.
நீங்க முதலில் இருந்தே சிறுக சிறுக செவிக்கலாம். விதிகளுக்கு
Aarti has been closely tracking Indian financial markets, investment products and regulations for over 25 years now, and is also a member of SEBI, the Market Regulators Mutual Fund Advisory Committee. Yeah, Aarti, you can please take your seat. On the panel today is Mr. Dikshit Mittal, Fund Manager and Senior Equity Research Analyst, LIC Mutual Fund. Mr. Mittal is a CFA and has about 16 years of experience in research and fund management. He has been with LIC MF since 2020. Happy to have you, sir. Very glad to invite Mr. Ravi Saraogi next, the co-founder of Samasthiti Advisors and a SEBI-registered investment advisor. His work experience spans fundraising, equity research, as well as business intelligence domains. He is a CFA charter holder and was recognized as one of the 40 under 40 outstanding professionals by the Indian Association of Alternative Investment Funds. Welcome, Mr. Saraogi. It's also a pleasure to have I took the privilege of calling you last because this is home. An expert from Coimbatore on the panel, Mr. Sheilendra Bhansali, Senior Partner at Kumbhat Co, Chartered Accountants. He specializes in corporate internal management audits, bank investigations, but his super specialization is probably financial planning for high net worth individuals. Keenly interested in quizzing, he is the Vice President of Coimbatore Quiz Circle and has conducted over 300 quizzes, a frequent speaker in various professional and academic forums. Welcome, Mr. Bhansali. Over to you, Aarti. You can take it forward. Yeah.
Thank you, Vardhini. That was a very good presentation. So I think she set the backdrop for what we are going to talk about. So I won't be repeating any of those numbers, etc. again. So to kick off straight away. So Ravi, you've done extensive research on this, the amount that people actually need in order to retire, right? Many young people nowadays nurse this dream of retiring earlier in their 40s or 45, etc. and they want to just chill at home, right? But is that practical at all? Because what is the number actually that you need to retire in India? Now, many people like to use this US thumb rule which says 25 times your annual expenses. So I've heard people saying, so if my annual expenses are 5 lakh rupees, 5 lakh into 25, 1 crore, 1.5 crore, I have that money, so can I retire? So how do you actually arrive at this number and what is the number that you think is fit for India?
Okay, so based on our research, what you need to do, there is a very simple methodology that you can adopt to estimate what corpus that you require at the time of your retirement. So let's take a typical example. Most people retire at the age of 60 or you are intending to retire at the age of 60. So you need to compute what your annual retirement expenses will be in the first year of retirement. So let's say you're 45 or 50, you're spending a certain amount. So you need to inflate that number and calculate what that expenditure would be when you are 60. That annual number you need to multiply by 33 times. So that would be a safe retirement corpus to last you till about a life expectancy of 90 years. Now, if you're not going to retire at 60, but you're looking at an early retirement, and a lot of youngsters, like you mentioned, Aarti, look at an early retirement as an option, this number will grow higher. So for example, if you're looking at retiring at 55 or 50, the number of times expenditure that your corpus needs to be can go up to as high as 40 to 45 times. So this is broadly, the crude methodology that you can, use to arrive at your retirement corpus.
Right. And how you are arriving at that number is, in the first year of retirement, you can only withdraw about 3% of your overall corpus. That is what it is, right? So your whole corpus should be such that in the very first year to meet your expenses, you should be withdrawing only 3%. So it is not 8%, etc., like we were seeing in that illustration, right? So that's how after doing all the calculations, this is the number that we arrive at, right?
Yeah, in fact, that's a very important point that you mentioned because, let's say you are 60 and you have a retirement corpus of 1 crore. And let's say you don't want any complication. You simply take that 1 crore and keep it in a bank fixed deposit. And you can actually earn an income of 7 lakhs. As per the new income tax regime, for 7 lakhs income, you won't have to pay any tax. So that entire 7 lakhs actually becomes tax-free income for you. But the problem with this computation is that you're not going to require 7 lakhs 10 years down the line, right? Because of inflation. So the number that you need to spend while you may be earning 7 lakhs from your fixed deposits, the number that you need to spend will be lower. And that is purely to account, for inflation.
Right. So, Mr. Bhansali, now when it comes to retirement, most people start to think about retirement only in their 40s or 50s even. But to get to the kind of number that he's talking about, a much early start is required, right?
Yeah, so thank you, Aarti, for this question. Glad to be here this evening. 40 and 50, in my opinion, is rather late to start off because we are looking at humongous numbers here, which is the reality. what the panelists, I'm sure, are not trying to do, they're not trying to scare you. They're just trying to see that you plan for retirement because you're having a long runway ahead of you after you retire. So that is the reason why I think this entire exercise is being undertaken. Now, there is no escaping the fact that you need to start planning early for your retirement. And the way expenses are going up, it becomes more and more difficult as you age to save that corpus which you need for your retirement because of issues like longevity, which Parvatha Vardhini mentioned in her introductory remarks. If you're going to live for 30 years beyond your retirement age, your lifestyle will require a certain amount of expenditure every year. And that cannot be taken care of by a corpus which is much lower than what will generate enough returns for you to take care of your lifestyle. Plus you will have diseases, medical expenses, and there is a limit to what can be covered by medical insurance as well. So you need to factor that as well. So it is essential that you start, I personally feel, and that is what I advise either my clients or my clients' children now, or their grandchildren in some cases, is the day you earn money, is the day you start investing. If you start your job on the 1st of April 2024, your first investment should be on the 1st of May 2024. That is as early as you can start. Otherwise, it's very difficult to achieve the corpus, which will make you happy through the rest of life. Because retirement is supposed to be the happy period. So you need to plan for that.
Yeah. Yeah, sure.
In fact, that's a very valid point that you make, because I think there is a lot of fear attached to retirement planning, because we keep coming across these lofty numbers of retirement corpus that you need to achieve. Vardhini, for example, showed in her slides how a 6 lakh expenditure will multiply into 60 lakhs, in 30 years of time. I feel these numbers are of course important because we need to appreciate the math. Inflation is there. But we don't, need to be disillusioned, because, let's take a simple, example. If somebody is 35 years of age, and based on our methodology, if they were to calculate what is a retirement corpus that you need, so somebody targeting a pension income of 1 lakh today, and you inflate that, the retirement corpus will be in the range of 10 crore. And the first problem is that most people don't appreciate the fact that it's 10 crores when you are 60. So if you're calculating 10 crores when you are 35, you don't need to get bogged down by that number, because that's a future value number. Second, when people calculate how much I need to invest to accumulate that 10 crore, based on typical return assumptions, if somebody is 35 today, you will need to invest about 80,000 rupees. Now that's a large number, and people get disillusioned. But if you use a step-up SIP, you don't need to actually invest 80,000 when you are, 35. If you invest 28,000 rupees when you are 35, and you just increase that number by 10% each year, you will actually, get to 10 crores. So 10 crores is a future value number. It's not present value. Second, if you use a step up in your investments, you will arrive at a more realistic amount that you need to invest.
Right. Yeah, so what I'm taking away from that is some people think that they shouldn't start because they don't have enough money and they just postpone it. And actually that postponement actually costs you far more than what this not having money bit will actually cost you. So if you have less money also, just make a start and then you can build on it, step it up as your income increases. That is what is important. Now coming to Mr. Mittal, in India typically when you talk of retirement, if you're a salaried employee, people think of Employees Provident Fund, and the others invest in PPF. And EPF is this black box where you keep putting money, so people think a lot of money is there in EPF. So the day I retire, I can just take my EPF and it will be enough, right? So why do you at all need mutual funds in retirement planning?
Yeah, you are right. Most of us basically depend on fixed income products for our retirement. And if we see EPF balance today, so basically that is earning around 7 to 8%. PPF is earning 7.1% and EPF is earning close to 8%. So as it has shown in the presentation earlier, though inflation is 5 to 6% official inflation, but actual inflation, especially for the post-retirement year like healthcare or education, so it is much more than 6%. It may be 8-9% kind of inflation also. So in effectively, if we are investing into PPF or other fixed income in avenues, basically we are just preserving the value. We are not creating the wealth. We are just preserving the value of our wealth. So in a sense, we need instruments which can grow much faster than 8-9%. So that incrementally we can create wealth for our retirement year. So I think equities as an asset class historically have proven that I think in the presentation chart was shown in 40-year 12 to 15% CAGR return has been given by the equity. So 3 to 4% extra return over a 30-year investment period snowballs into a large sum. So just to give an example, like if you're investing 10,000 rupees monthly, at 8%, I think in 30 years it will be only 1 CR. But if you can invest that amount at 12%, it will be 3 CR. So only 4% additional return accumulates your wealth by 3 times. So I think that is the power of equity or power of instrument which can generate better returns. So to that extent, I think one should have mutual funds also in one's portfolio.
Right.
Yeah.
So coming to Mr. Bhansali, he gave some return numbers and he comes from a mutual fund. So I want you to independently tell us, I mean, what are the kind of returns that a person can expect from, say, equities, from debt, from gold perhaps?
Okay, so like Mr. Mittal mentioned, the power of compounding is huge. And you can take advantage of that power only if you're invested in equities. Because that is where you'll find a typical hockey stick diagram as far as equity investments are concerned, where in the initial years, the stick will move like this, and then you'll see an exponential growth. That is possible purely in equity mutual funds or direct equity investments. But since we are sitting here, I would talk more about equity mutual funds. Now, we've been in this investment advisory business for the last 25 years, and I can say without an iota of doubt that this is the best route to accumulate a corpus for your retirement. There are many clients of ours who also have equity post-retirement. We advise them not to give up equity investments completely. You have a certain corpus in debt instruments, and you also have a certain corpus in equity instruments, because equity instruments will continue to give you a return which is above par, and debt instruments will give you returns which are at par. So at par investments will give you maintenance expenditure. Above par investments will give you the benefits of a better lifestyle. So I think this is important because ultimately we are human beings. We cannot be bogged down by numbers in our day-to-day activities. Tomorrow if I want to have an ice cream, I can't go to my Excel sheet and see whether I have 100 rupees extra available for an ice cream, right? I need to be practical in life. So your ice creams you will get from equity mutual funds. Your idli and vada you will get from your debt mutual funds.
Right. Right. So to save for retirement actually, do you need suppose I am young, I'm in my 30s. Do I really need debt in my portfolio at all? If equity can give me 12-13%, why should I have debt? I mean, what do you feel about that?
So yeah, I generally we recommend clients even when they are young to open a PPF account, for example, and sometimes there is pushback that a PPF is going to give me 7 to 8% return. I have a runway of about 20-30 years before I retire. So should I at all invest in PPF or not? And can I maintain a 100% equity strategy? So we discourage 100% equity strategy. And that's simply because diversification is the only free lunch which is available for an investor. It's important that your portfolio, even at an early age, have some component of debt investments. Of course, you can be predominantly invested in equity, but you need that ballast of debt investments. And that is because you need to account for the unknown. We live in a world where every 10 years the world is completely changing and we don't know how the future will look like, right? So it's important that, there be certain amount of debt investments, like for example, public provident fund. Essentially your counterparty in a public provident fund is the government of India. That's the safest you can go. And it is by actually having certain amount of safe debt investments that allows you to take equity risk. What is it that gives somebody the confidence to actually withstand a market crash? that confidence of not doing panic selling comes from having accumulated balances either in your EPF, in your NPS, or your PPF. So I think it's very, very important,
So when we look at these returns like 12 to 13% compared to 8, etc., in equities, the 12 to 13% doesn't come in a linear way. So one year you will get for 40%, the other year you may get minus 15%. So it's a very bumpy ride. And if you have fully equity portfolio, that might be a little difficult to actually go through. That is what he's actually trying to say. So Mr. Mittal, when it comes to choosing mutual funds for retirement savings, there are 36 categories of mutual funds. So which category should the person choose?
Yeah. So you're right. Sheer number of categories can overwhelm anyone. So basically, which category to invest depends on basically 2 to 3 factors. First of all, and most important, is the risk appetite. So if a person loses sleep with wild variation in his retirement corpus, so he has to go for slightly conservative schemes like balance advantage fund, or maybe conservative or aggressive hybrid funds. But at the same time, the person who has his final goal in mind and is not bothered about the day-to-day volatility, so he can go for slightly aggressive schemes like pure equity schemes, large cap, mid cap, small cap, or combination. One is the risk appetite. Secondly, one thing one needs to see, what is the goal, financial goal. If the goal is only to preserve wealth, then one can go for debt mutual fund. If goal is to create wealth, one should go for the equity mutual fund. So, and then finally, the thing is one has to keep the taxation also into mind, because different categories have different taxation. So that also plays into mind. But primarily it's the risk appetite and wealth creation goal. So these two things will basically determine.
So Mr. Bhansali, when somebody comes to you for retirement planning and you have to tell them what categories to choose, how do you go about actually helping them choose?
Okay, one of course is the age of the person who comes to us. Age is critical. Secondly, we need to look at risk appetite. So there are some people who will get a heart attack if the market drops by 10%. Some people won't lose any sleep at all. So it is very critical that you understand the other person's risk appetite, because it is not your money, it is his money. So that's also essential. And then we also need to say what kind of work they are in. What is he a businessman or is he a salaried employee? What is the potential earnings that they have over the next 20, 30 years, or whatever time period is available? And will he actually retire? That's also a very important point, because not everybody retires. But you prepare for retirement. You don't really retire, but you prepare for retirement. So that also is a factor when you're doing calculations. So I wouldn't say it is. One more very important thing is we involve the family members as well, because it is not one man's decision. So a retirement of a person actually would mean that if it is a sole earner, then it is the zero revenue after a certain age for the entire family, provided they are all dependents, or at least two of them will be depending on one income. So what is the impact on the partner? That is also essential. So a combination of these factors leads us to designing a scheme for each individual when they approach us for retirement planning. Of course, we look at taxation, but taxation is very difficult to plan for, because it might change in July when the budget is presented. So we really don't know. But with what is available, you plan.
So this question is for you, Ravi. So suppose I have started investing like the ideal investor from 25 or 30, and I'm approaching say 50. Actually, I am just close to 50. And suppose I plan to retire at 60. So should I start at this time moving more money into debt investments from my equity? Or can I stay with equity till I retire? I mean, what would be the good thing to do?
No, it is important to do portfolio rebalancing. In our research, we have identified that an allocation of about 60% to debt and 40% to equity works really, really well for a retirement portfolio. So, when you're approaching your 60s, you have to rebalance your portfolio to try and come, to this mix. You can either use 40% equity, 60% debt portfolio, or you can use 40% equity, 50% debt, and 10% gold. Because the addition of gold in the portfolio, it stabilizes the retirement portfolio. It works really, really well when we look at it historically. So this mix of asset class is important. Now, in our experience, what we see is that you have two categories of investors. So risk and return is very binary, what we observe. So there'll be one category of investors who will be so risk averse that they will have nearly 100% fixed income portfolio. And it becomes a big challenge to create a 40% equity allocation. For somebody who has never had even a 10% allocation to equity investments, at the time of the retirement, creating an allocation of 40% equity, that's a big challenge, and then we sometimes have to climb down the share of, debt equity that we have to give them. And there's a lot of behavioral, aspects that we have to speak to the client about. At the other extreme, you have a category of investors, like you mentioned, a lot of youngsters, they may feel that debt investment is for tatas, so I'm going to go with 100% equity allocation. And these, category of investors are actually approaching their retirement with 70 to 80% allocation to equity. So there, the reverse work has to be done, where it has to be explained that while equity is of course a great wealth creator, but the nature of equity in your portfolio changes between accumulation phase and distribution phase. So when you are in accumulating your retirement corpus, equity, you can maintain a very large share and it works really well because you are not doing any withdrawals. So that compounding cycle is not getting broken. It works really, really well. But the moment you have equity in a portfolio where you are subjecting the portfolio to a monthly withdrawal, the moment you play out that, the dynamics of equity completely changes. Let me give you an example, of somebody who had a very high share of equity and was withdrawing money from that portfolio. Now, if in the first 5 to 10 years of the retirement, if equity returns are very bad or there is a crisis that happens, that has a very debilitating impact on the overall portfolio, because you are actually withdrawing from your equity portfolio when the market is significantly down. And then, you are not able to play catch up simply because you have actually eaten the principal component of your, equity investment. So for people who are primarily on fixed income, we have to get them to 40% equity. For people who are too risky, we have to bring them down to a more reasonable level of equity.
To explain the risk that he's talking about, suppose a person retired in 2007. I'm taking that year for a reason. So suppose that person had 40% in equities or even higher, 50% in equities. Very next year, actually, the Sensex and Nifty fell by over 50%, 50. So when that happens, actually you lose a lot of your capital in the very first year of retirement. Suppose I have 1 crore and suddenly I'm losing 25 lakh of it in the first year. And I have to withdraw because I have to withdraw in order to meet my living expenses. So it is for that reason that having this equity debt balance is very important. Of course, if we are lucky people, like recently you retired in the COVID year of 2020, after that market has been up and up. So if you had equity, you would be overjoyed and you will happily withdraw from it. But we won't always have markets which are like this, right? We could have falls, and this withdrawal rate is very important for that reason only. Mr. Mittal, do you think people should have equity in their portfolio post-retirement? If so, what kind of funds can they use? There are also hybrid products, right?
Yeah. So definitely, as Ravi also mentioned, one needs to have equity even post-retirement. But how much equity? It will again depend on basically 2-3 factors. First of all, age of retirement. As you mentioned, some people are looking to retire in their 40s also, or even at 55, 60 also. So basically, the younger you retire, the more equity you need, because the corpus need to last your full life expectancy of 80 to 90 years. So that is the first factor. Second is basically your alternate source of income. Like if you have 2 to 3 sources of income, you have pension, you may have some rental assets which is coming in. So then maybe you can afford for higher risk and go for higher equity. But if you are solely depending only on your retirement corpus, I think then one should be slightly more conservative. Third, basically, what is your goal post-retirement? For example, if you want to leave something for your next generation, So that means you want to die rich, then you have to have some equity in the portfolio. But if you don't want to leave anything, as I was discussing with Vasu, sir, basically I think 10% of the people die without any money. So if you want to die like that, I think one should be shunning equity. So I think it's a combination, but these 2-3 things I think will determine, yeah.
You may not be lucky enough to know exactly when you will die and
yeah. So one has to
clean out your bank account.
One has to prepare for the best. I think one has to think that I'll live 100 years. Then I think that is the way to, I think, plan. Yeah.
Right. So, Mr. Bhansali, a lot of what we discuss in financial planning, even SIPs, etc., right, applies to salaried people more easily, right? Only if you have a salary and every year you get these increments of 10% that he spoke about, which none of us get. So, then you can do step-up SIP, right? So, but for self-employed people, what do they do? Because their incomes are quite lumpy and they may not and most of actually India's workers are self-employed. So, how do you advise them to create a retirement corpus?
Very simple. I use the same principles that I use for salaried employees. The most important point to be followed by anyone, any investor, is discipline. If you're not disciplined, you will never achieve your goal. So if you're a salaried employee and you're getting 50,000 rupees a month of salary, 20% is to be invested. And I always tell people who approach me is that you invert your thought process. This question arises, I don't have anything left after spending. I said first you invest and then you spend. So if your salary is 50,000, you first decide to invest 20,000 or 15,000. Assume that your money available per month is only 35 to 40,000 rupees. That is how you can invest. Otherwise, you will never be able to invest. So to that, just take it across to people in business who get income on a lumpy basis. Not necessarily that every month they'll receive the same amount. For such people, again, I'm saying invest a minimum amount in an SIP, whichever is comfortable. For the others, whenever you receive your lump sums, invest those lump sum in a debt fund and move it to an equity fund by the systematic transfer plan route. Okay. So do an STP, which is akin to an SIP in a different format, of course. So the discipline is maintained. You always know that whenever you receive money, you have to put it in the debt fund, and then it automatically gets transferred to an equity fund. For your regular investments, run the SIP, whether you're a salaried person or whether you're a businessman. Definitely start off an SIP or a PF investment, whatever. When I say SIP, not necessarily an equity SIP, it could be a PF or it could be any other form of investment. The reason why we're asking you to do it on a discipline in a monthly fashion is to enforce the discipline that is required of investing. And with disciplined investing, the 10 crore target that Ravi was talking about is not difficult. It is entirely achievable if you are disciplined in your approach. You will easily achieve those targets. You just need to set the target and start. Starting is important, and being disciplined about the journey is important. The goal will be reached. That is what my experience has been.
So let me come to this part where once you retire, what do you do? Because all the fixed income instruments in India, the safer ones, they are all taxed in a very punitive way. And we know that even debt mutual funds now are taxed at slab, whatever returns you make are taxed at slab rates. So you have accumulated a corpus through your life through a lot of difficulty, and once you start withdrawing from it, you find that it is being taxed at 20% or 30%. So what do you really do to minimize the impact of tax on your withdrawals? Mr. Mittal, could you just weigh in on this?
Basically, equities has a very beautiful concept called systematic withdrawal plan. Like it's basically a reverse of SIP. In your basically earning years, you invest monthly, and during your retirement, you basically withdraw monthly. So that is, and plus it's quite flexible also. You can, based on your circumstances, you can reduce or increase your withdrawal rate. And to that extent, it's very tax efficient also, because when you are withdrawing, for example, 5 to 6% of your total corpus, So you are withdrawing, one is majorly principal component, and part of that is basically the return component. And currently, I think regulations state that I think 1 lakh of the capital gain is again tax exempt. So I think systematic withdrawal plan is a kind of efficient way, tax efficient way, as well as the more flexible way of withdrawing from the retirement.
Ravi, what do you tell clients? I mean, what is the best way to withdraw?
So I think, fixating on safe withdrawal rate, whatever, the clients work with, whether it's 3.5%, somewhere in that range. And then doing a withdrawal is one way of looking at it. Sir mentioned, systematic withdrawal plans is a great option. But what we generally observe is that, asking clients to withdraw based on a safe withdrawal rate is not a very intuitive way for them to understand how the withdrawals will actually work. So I think, you can use a bucket approach. So where you segment your retirement portfolio into different buckets, and then you use those different buckets to withdraw money. So for example, if somebody, wants to be very, very safe, what you can do is you can let's say you are 60 years old. You calculate from age 60 to age 70, what will be your total living expenses. So that living expenses, you can simply put it in a fixed income instrument and be assured that irrespective of what happens, for the next 10 years, your living expenses have been secured. Now, once you have the confidence that the 10 years of living expenses have been secured and they are kept in a fixed income instrument, and even if it's at a punitive rate of taxation, but the financial security is there, the balance money can actually take equity risk. Now, if you look at, so we have data for Sensex from 1979, right? So that's a good 45 years of data. So you analyze these 45 years and you see if somebody has invested in equity for 10 years, what is the probability of them making a loss? So that number is actually less than 1%. So if somebody was investing in 1997, withdrew the money in 2007, that's a really unfortunate example. Yeah. But if you are so unfortunate, then, we can't, then you just have to leave the things at God. But apart from that, 99% of the times, people have actually made good returns in equity for 10 years. So if you don't touch the equity component of your retirement corpus for 10 years, you're pretty much secure that you will do a lot of wealth generation. So create a bucket of 10 years, use that as living expenses, let equity work its magic over 10 years, and then you start withdrawing the excess gains from the equity portfolio. You can either rebalance it into your first bucket, which is the living expenses bucket, or you simply do a withdrawal from there and, you can get your pension income at a lower tax rate. So that's one way, of looking at it.
So, Mr. Bhansali, when we look at more traditional pension options like annuity plans, etc., taxation is very unfavorable, right? I mean, many people like to have that fixed pension coming in. But how can they achieve that?
No, I think compared to what the traditional schemes have been, the new NPS scheme is, I think, wonderful. Yeah. So that is something which all investors can actively look at. Whether you do it through your employer or you do it on your own, the NPS scheme is a fabulous method of building your corpus over a period of time. It is beneficial in terms of an annuity return as well. Plus the fact that it is very low operating costs. So your slightly better return you can get through an NPS scheme. Of course, you have less, you can't say much about who's doing what there, but it is doing fairly well over the last few years that the NPS has been in operation. That's a wonderful way. I'll probably expand on what Ravi said about bucketing your investments. So you look at so I call it your maintenance expenditure. Let your maintenance expenditure be met out of purely fixed income instruments, give it you regular return. Forget taxation like you said, because you need surety, you need comfort that you will get this amount every month. That is something which you don't want to worry about when you're retired. The rest of it, like I mentioned when I started speaking itself, is that you need an equity component in your investments, which Ravi also corroborates with research, saying that if you are invested more than 10 years in equities, there's just a 1% chance that you will lose some amount of money. A 1% chance, 1% is like saying I'll cross the road and not get hit by a cycle. So, that's as remote as that. I think it's worthwhile taking that kind of risk as far as your retirement corpus is concerned. Keep your maintenance corpus separately. Keep your growth corpus separately, because you will definitely need growth corpus if you have to live peacefully for the next 20, 30 years post-retirement. Absolutely essential. Taxation is a less of a worry because we do not know what will happen 20, 30 years later. I'm not too worried about taxation at this point of time, but it is essential to note that most people are in the 10 to 20% tax bracket. Very few are in the 30% plus tax bracket. So when somebody is trying to sell you a product which says that you will end up paying 30% if you do in ABC and this D will save all taxes, take it with a pinch of salt, because you might not be in the 30% bracket at all. You might be only in the 10-20% for which there are 10 other products available to you. So look at that very carefully when somebody is talking on selling a product purely on the basis of tax efficiency. Look at it once again, see that the tax efficiency applies to you. That is most important. Most people don't look at that.
That's a very good point. Also the point that taxation can change at any time. So if you're talking of things like retirement planning, tax shouldn't be such a large consideration. Yeah. So final question before we go to audience questions. So how should you plan this post-retirement period if you want to leave a legacy for your descendants? And how should you plan it if you just want to spend off all the money and not leave anything?
This is a favorite question of mine because I get asked this many times. So I have two answers to this. One is a very clear-cut, practical answer that you cannot spend all the money. Because if you spend all the money and if you still live, then what will you live on? Unless you have very nice children who are willing to accommodate you, who are living with you or are willing to spend money on you. But let's keep that aside because that's not practical. So you need to have a corpus because all of us have a certain self-esteem. We want to live off our own resources. We don't want to depend on children. All those things are there. So keep that corpus alive till the time that you pass away or pass on, and it may go to a dependent. Now, the question that comes to the second part of my answer. Do you want to keep it for your dependents who may not be your dependents anymore because they are not supporting you, you are not supporting them, so you are living on your own. So do you want to keep it for your children or grandchildren, or do you want to give it away? Today the options of giving away are phenomenal. So it is better to leave a legacy which suits you as a person. If you want to give it to your children or grandchildren, give it to them. If you don't want to give it to them, give it to charity or any other cause that you like. So the solution to that is writing a will. All of you, I suggest, always write a will, however small or big your corpus or your wealth is. Because it lends a lot of clarity to what you are leaving behind. And it leaves less trouble for all the people who follow you because they find it easy to dispose of your assets, whether it comes to them or whether it goes to somebody else. At least the paperwork is clear and it is less troublesome for anybody who follows. These might be morbid things to talk about, but these are essential. And this is a conversation which everybody needs to have with every member of the family. Please write your will. It doesn't matter whether you're leaving 5 lakhs behind or 50 crores behind. Please write your will so that your legacy is taken forward, whether by your children or grandchildren or by some other cause that you like.
Right. Are there any closing remarks, Ravi and Mr. Mittal?
Maybe I'll just want to add to that. I think the question of whether you would like to leave something for your kids, I think it's a pre-decided question because, for most retirees, they may add real estate investments in the retirement corpus and it gives them financial security, but practically nobody monetizes it. Right. So the fact that in your 30s and your 40s, you buy a home or, we tell clients that that's implicitly a decision that you have taken of leaving an inheritance asset. When you're in your 30s and 40s, you might feel that this real estate investment will add to my financial security later on. And of course it does if things comes to, some emergency. But more often than not, people actually leave aside gold investments, physical gold investments, and real estate. So we actually encourage clients that don't think about creating another enclave in your financial assets for inheritance, because you're anyway going to be leaving quite a bit to the next generation.
Do you have anything to add, Mr. Mittal?
Ravi has summed it beautifully, so maybe we can take questions.
Right. So,
Well, 1 minute, just before that. There's something which we've been coming across a fair bit over the last few years. When Ravi brought up the topic of real estate, we find that many of our clients, their children are not interested in real estate beyond one property. They're saying it's too much of a hassle, it's difficult to liquidate, the paperwork is enormous, and in many of these cases, the children are not living in the same town as the parents are living in. They find it extremely difficult to manage, so then the real estate becomes a liability rather than an asset. So that is something which also needs to be taken care of when you are thinking about investments. How much of real estate do you need in your portfolio? Is it the house that you live in, or something beyond that? Which again brings us to the legacy issue, which Ravi also expanded at length on. So would you like to leave one house for your kids, or 2 houses for your kids, or 3 houses for kids? Are they comfortable with 1 house, or are they comfortable with 3 houses? That's again something which you need to, unless it's an income generating asset. But again today, children are saying that don't give us real estate. If you want to leave a legacy, leave something in the bank.
So thank you so much. I think that was a very good discussion. So if the audience has any questions, please stand up and ask your question. Yeah. Yeah, there is some.
You hear me?
Yeah.
Thanks for organizing this conference and a caucus panel of experts sharing their guidance for retirees and financial youngsters. But whatever calculation, Ravi, can you just explain further that 33 and 40, 45, the number which you have? One more question which all of you all have said that we as men, you're saying after retiring you live for another 20 years. What about the spouse?
Yeah.
Who may live even another 10 years after we leave? If that is the order of God calling you. Is the plan inclusive of these things? That's what I want to know.
Before coming, I noted down this illustration because I generally feel that every time there is discussion about retirement, there is a lot of negativity. So I thought I'll take an illustration and show that how unachievable numbers, are achievable. So I took current age as 35. Somebody who's 35 years old. I assume that they'll retire at 60. So they have another 25 years of investments to do. And let's assume that at 35, they are at 0. I assume the life expectancy of 90 years. So, mostly people take 80 years, 85 years, but it's always, better to be safe. Now, I assumed that, like I mentioned, 60% in debt investment and 40% in equity. So let's assume that, 60% of the corpus is actually going to be invested in that at the time of retirement. When they are going to retire at 55, 60, at age 55, they will have to rebalance the portfolio. I assumed equity return of 12% and debt return of 6%. I think historically, if you see equity CAGR is in the range of 15 to 18%. So 12% is reasonable, debt returns of 6%. I took inflation at 6%. So essentially, I'm saying that on your debt portfolio, you're not going to be getting any real return. Whatever nominal returns you're earning on your debt portfolio is going to get fully eaten up by inflation. This is just to be conservative, which is also a reality because if you look at data from 1990s, 2000s, you will see that debt investments at best, if you are lucky, will give you 1% real rate of return. That's a separate problem, for the government to tackle. But, that's not a case not to have debt investments. We cannot decide interest rates. We are price takers. Whatever interest rates is there, we have to take that, right? Now, so this individual, let's assume that this individual at the age of 35 is spending 1 lakh rupees a month. And the best estimate of what you will spend in retirement is to, one crude way is to simply say what I'm spending today, I'll actually spend in the future. given that you may actually be spending towards your kids, your kids might still be going for school, your monthly expenses might be including their expenses. So at your retirement, you may spend lower, but your medical expenses might go higher. So whatever decline in retirement expenses is there because of certain expenses not being there will be offset by probably higher, medical inflation. So this individual will require 10 crore when they are 60, which looks like an astronomical sum, but like we spoke, 10 crores when they are 60, not today. So per month investment required is, if you do a step-up SIP, is 28,000, which for somebody who's spending 1 lakh rupees a month, right? And assuming that, they are earning, 1.5. So effectively, that's a savings target of 20 to 30%. Broadly, that's what planners encourage people, that you should save, 20 to 30% of your income. So that's how the math works out. If you don't look at it from a step-up SIP basis, then the number is actually 80,000. So if you were to accumulate, 10 crores, assuming a constant amount of investment each month, then that's, a much higher number. But 30,000 or 28,000 looks a lot more reasonable and achievable.
No, I think he was also asking, how did you get that 33 times and that 45 times?
Okay. So I think one of the problems that we as planners face is when clients come to us and say, I want to retire, that can I retire now? And how much can I withdraw? Now that's a very big responsibility and a problem for a planner, because somebody is going to spend 30 to 35 years in retirement. Now, how are you going to project what returns they will earn, what will be the inflation? It's a big problem, right? So one way of addressing this problem is to assume a constant, a return that the portfolio will earn, but that's, that may not be accurate. So what we did was we did simulations. So we looked at historical market data, and we took a retirement portfolio and we simulated that retirement portfolio. We asked the computer that you throw all kinds of equity and debt returns at this portfolio, and then you check how much withdrawals it can sustain. So across this multiple simulations, we arrived that if you, have 33 times, corpus of your first year in retirement, 97% of the times the math will work out. So that number is based on simulations. We take different scenarios and arrive at that number.
What is the longevity assumed?
90. Yes. Yes. Yeah. And that'll be, that'll be a good corpus to have.
In the US, they typically say 25 times. I think in India, it goes up because of inflation, and here the equity market is also very volatile. I guess that's another reason why it goes up.
One very vital point, just to add to what you said. Yeah, I'll get back to him, but I just got reminded of this. We recommend that you take very good medical insurance before you retire, or much before you retire, because that is going to be your biggest component of expenditure, and it is unknown. The figure is unknown. So your corpus may or may not sustain a substantial medical expenditure. Normal medical expenditure for routine processes, your medical insurance will take care of, but you need to have insurance in such a way that it will take care of extraordinary expenditure as well.
Sadly, medical insurance is not that great, because they give you only 50% of the claim, and secondly, they say you should be hospitalized for at least for 24 hours.
No, that's a different debate altogether.
I had a close friend who expired. In the last day of his death, there were so many multiple tests conducted, okay, and the expense was too high, but he didn't sell. The moment he was admitted to the hospital, he died within 8 hours. Insurance didn't pay anything. It was a very leading insurance company. So I don't think so medical insurance is so good. It's better to invest in mutual funds and save and use that money than medical insurance.
Yeah, budget for additional corpus. I agree with you, because I have also faced this problem. I mean, they don't reimburse you, or the condition is not reimbursable, and you may not always be hospitalized, right? You may have other conditions.
I think that should be regularized by the government. Government should look into these things.
If you are alive.
The second part was not answered. Whether this 20, is taking care of the spouse.
Yeah. So we are taking 90 years of life expectancy. So that's to account for the fact that, either of the members could live till 90.
Usually stay till 80s, I see that. The female usually you can take 10 plus because they eat less and they are more healthy.
So you think 90, we should take higher than 90? Okay.
Will that cover, I think?
Together, when you calculate the expenses for a family, it includes husband and wife both spending. So what happens, the life expectancy, what you said, 90 for lady, they have already covered it, actually speaking. So the highest possible expense is up to 90, which has been covered when he did the calculation.
Yeah. Any other questions?
Yeah, this conclave would not have come at the most appropriate time because I'm turning 60 in another few days. Okay. Just two things. I have two questions. Before that, just to give a background. I started earning at 18. I'm now going to get 60. From the first job that I got, I have been saving 30% of my salary. And
That's
I retired 7 years before I was supposed to have retired. Now coming to the question. Okay, when I invest in mutual fund, there are two ways how I can do it. One, which is called a direct method. Second, which is a regular method. Okay, when I approach my ICICI Direct, so they take orders from me, they put that investment and it comes in demat in 2 or 3 days. Okay, the percentage of that, whatever, brokerage, etc. is more there. If I do direct, so I am approaching a mutual fund company, say LIC Mutual Fund, and I am filling up those whatever forms, physical forms or online forms, the percentage of that expenses is less. So over a period of time, say 5 years or 10 years, it matters. Okay, it balloons up to lakhs of rupees. So how can I do a direct mutual fund investment and put it also in demat? Otherwise, my descendants will be running around to all the mutual fund companies and getting, of course, there is a chance, but still. So it's difficult at the time. This is first question number one. Second one, also I'll complete it. I have 3 annuities. I retired from private sector, so EPFO. I have NPS. So almost 5 to 6 months in a year, I'm giving a certificate that I'm alive. So is there one agency which can manage the KYC part, the way they have the centralized KYC? So whom to approach or what is the future of that? 2 questions. The first, direct and regular plan.
Regarding direct and regular, I think you answered the question yourself.
Yeah.
So when you said you had to run around,
right,
that is when you don't need to go direct because somebody else will do it for you. Okay?
Yeah.
If you're doing direct, then you have to handle everything. Whereas if you go through an advisor, then that advisor will help you in getting all these things sorted out. So that is the cost you're paying for that additional service.
That can't be avoided?
It can't be avoided because that's a cost. It's a cost, right? It's a cost. If you want to reduce it, you go direct. If you don't want, it's like saying that I will do a telecall and get my stuff done, or I meet somebody in person and get stuff done.
Okay.
So you cannot avoid. There's a cost to be paid for service rendered. That cannot be avoided if you want decent service to be rendered to you.
Perfect.
So that is a call which you will have to take. The other part regarding annuity and single point, I am no expert on that. All I know is the very fact that you're alive and filling up KYC forms every month from which government department, that itself is time consuming. I think this is the least of your problems at the moment.
Okay. Thank you. Thank you.
On direct versus regular, I just had a point. So whatever investment you do, I mean, you cannot just look at the cost. I mean, you should also know whether you will be able to choose the right products post-retirement. all investments need review. I mean, very periodically you have to keep changing. Tax laws also keep changing. Returns keep changing. Market conditions keep changing. So, tracking all this and choosing the right products, reviewing it, revisiting it, rebalancing, all this involves a lot of effort. So, I find that only people who really like managing their money and they're really obsessed about all this and they can track everything, they can go direct actually. But the people who want to do other things with their life after retiring, beyond looking at their money, I feel they may have to take some regular or fee-based advisory service.
I'll give you a real life, sorry Ravi.
Yeah.
This is something which, I mean, I'm talking entirely out of experience. Now, investment is not simply maths. It is mostly governed by behavior. And behavior can be controlled only by bouncing off ideas. It cannot be done on your own. And where an advisor can help you is controlling your behavior. On your own, you will take irrational decisions. But if you bounce off your idea with somebody else, is when you will arrive at a proper decision, because it is well thought out between two people and somebody who is an expert in that field. So which is why I say use the behavioral expertise of the advisor to plan your finances better, and it's a very small price to pay for the benefit that you will achieve. We found this out during COVID. When most people were selling, the advisors were telling their clients to buy. So there, a normal investor, if you had gone direct, he would have panicked. But a behavioral person who knows the markets, who understands everything, who's a good advisor, will tell you to buy. A simple example. I'm saying there could be many more complications involved, but this is the simplest way I can put it across to you.
I think just like to make a point.
Fee-based.
Yeah, so completely agree with what Sir mentioned, because, I think there are very few true do-it-yourself investors. In my experience, I would put the percentage of do-it-yourself investors as less than 3%. There are some people who are so paranoid about investing, they read up all the literature on personal finance and they are as good as any, financial planner, and maybe for them, going solo is a good option. But I just wanted to, clarify that going direct does not mean you're on your own. Because there is a third option. So one is you can be a do-it-yourself investor and go direct. One is you can choose a regular plan and get the benefit, of an advisor. The third is you can go direct and work with an RIA, a registered investment advisor. So that's the third category. So, so those are the three, options for an investor.
So when you work with an RIA, you can go direct, but you have to pay a fee to the RIA, just like you pay a fee to your doctor or lawyer or whatever. So that's all. So I think one of our panelists has to catch a train, flight. So we can, I think I'll invite. Yeah, if there are more questions. So first I'll invite our editor to just present a memento in appreciation of our panelists, and we'll complete that. And if there are questions after that, we will take them with us. Yeah. Nothing?
It's variable. So different RIAs charge different fee. So you can visit them and consult with them and understand their fee structure.
Yeah, some will have flat fee, some will have percentage, so it differs on that. Yeah.
Yeah, that's our editor, Mr. Raghu Srinivasan, presenting a memento to Mr. Ravi Saraogi, co-founder, Samasthiti Advisors. Raghu, Mr. Sheilendra Bhansali, chartered accountant. The mementos are books from our Hindu group of publications, a book on Tirumala. Mr. Dikshit Mittal from LIC Mutual Fund. And not to forget a book also for Mr. Vasudevan Desikachari from LIC Mutual Fund. Thank you, Raghu, and thank you, panelists. Yeah, Mr. Ravi Saraogi and I, both of us have to catch a flight because, we need to go back to Chennai tonight due to personal reasons. So I think Aarti will continue to moderate the questions, and, the other panelists will continue to answer your questions. So thank you very much for turning out in large numbers for this first of the BL portfolio conclaves. We will come hopefully back again to Coimbatore for many more such events.
So are there other questions?
Actually, there is two types of investment. One, those who are having excess money, they want to secure their money. They will not expect that return much more.
Okay.
But we are into second category where I can invest money where I don't want to pay much tax to the government. If I'm putting empty land, the tax will be less. If I'm putting other investment, the tax will be more. At the same time, the return of money in the land I am getting more. You got my points? So, how do you connect with that? Second question is the gold investment money. In that, suppose I'm investing money in gold investment for 10 years. So, can I get money back at the time of gold rate after 10 years, or only the interest I can get?
Yeah.
Sir, regarding the gold, I thought since you mentioned that, I'll tell you. The gold fund, what I mentioned to you, it's basically, it tracks the gold rates, frankly. There is nothing different put in that. It is basically, we invest, your money comes like a typical mutual fund, you give the money to me, I invest in stocks. Here also, I invest in actual gold. The backup of the assets is there. None of the mutual funds regulated by SEBI have any schemes which doesn't have backup of assets. Please be rest assured. The money is invested in gold. It tracks the gold rates. So obviously there will be after 10 years, whatever be the gold rates, you can redeem it at that rate. Probably, see, any mutual fund has a basic expenses which will pay. That is the only thing which will be deducted on annualized basis on a monthly. Okay. So that is the other expenses is not going to be there. But fact remains, in a 10-year period, you said, there could be a big 10-year period where gold has not even raised. If you actually look at from 2012 to 2022, the amount of percentage of gold rise was much lower. You said various asset class. Gold has not been consistently going. Can you tell me why gold went up in the recent past? Nobody can tell. Because there is various factors which is affecting gold rates, unlike your equity or unlike your interest rates. Because interest rates will be a part of it, international markets will be a part of it, there will be inflation in a part of it, dollar currency will be a part of it. So gold rates may not be as expected as the moment, or your liquidation of gold will be happening on that day's market rates. There is nothing to worry. Only thing is the NAV is declared daily. It's another mutual fund where the NAV is declared based on the value of gold. So don't need to worry. If the gold really goes up a lot, what happened recently, even in gold probably last 1 year you would have got more than 50-60% return also, depending on how the move.
Okay.
Yeah, regarding your first question, I think no one can escape taxes, but I think if you have excess money and you are not going to withdraw, maybe you can park that in debt mutual funds, because unless you sell, I don't think you have to pay tax, right? Unlike in FDs, like when FD matures, you have to pay tax. So if you have excess money and you don't need to withdraw that, I think you can keep them in a debt mutual fund.
Talking about excess money am I having? Whatever investment I am having, where I am going to get return in high returns with the less tax.
So I think for that, equity is the best option, right? I think equity is...
If I am putting empty land, that will be more, no?
That depends on the location, etc. Sometimes land gives poor returns also.
Yeah. No, sir. I'm also paying less tax to the government compared to other investment.
Yeah, and when you, yes, I mean, because indexation is there for land, true. But you can't sell it immediately when you want. So you have to weigh various factors. I mean, liquidity.
So that's what, how to correlate
safety.
which one is I can get
no,
secured.
No, you see, even you tell me your land is secured. நீ பரந்தூர்ல லேண்ட் வாங்கியிருந்தீங்க நான் ஏதோ நினைச்சேன் இன்னைக்கு பரந்தூர்ல உங்க லேண்ட் உங்க கையில இல்ல. I'm just giving you an example. You cannot see here the asset class is different. asset class different, இந்த asset class க்கும் அந்த asset class க்கும் compare பண்ணி நம்ம return.
But finally what matters, sir? How much
No,
I
I
got in my
agree.
pocket?
See, end of the day, I have to accumulate.
What is in my pocket? I'm going to count.
So that's what I'm saying. Where I have to be secure at the same time on the tax liability. For that matter, your land tax laws also can change in next 5 years, 10 years. What you are saying, the so-called this one. Currently, you presume definitely land will go because the amount of land available is the same. So there is nothing, you can't expand land. It is available that much only. So land rates will go up. But will it be available for your liquidity on a day when you want to get admitted in hospital? No, it is not possible. So I'll just give you a simple example of my own house where I'm staying in Bangalore. The owner is trying to sell this flat for last 1 year. It is in the heart of the city. It's a fantastic place. They are not getting sold. It is not that whatever you want, you will get it on that day. Because of that, see, you have to see what is liquidatable, what is not liquidatable. Accordingly, you have to see your position, how much you have to keep it in illiquid assets. This is almost like an illiquid assets. But at the same time, it can give fantastic appreciation. That's agree. I don't deny that. 20 years you keep a land, you might get fantastic appreciation. But how much you have to allocate of your money into illiquid assets, how much you have to keep it in liquid assets, how much you are having in your bank account also you have to see, correct? Because you have to go and use your scanner and withdraw money there in any of the shops. So you have to allocate accordingly. Depending on that, the current tax rates on those days, it will continuously be applicable. There are days even equity was charged at 30% tax rate. Today equity is charged at short term as 15 and long term as 10. It was long term was 0 just 1 year, 1.5 years back. So these tax rates you cannot plan, as they were saying in the initial this one. You can't plan with the tax rates in mind because 30 years down the line, what is going to be, 20 years down the line, what is the tax rates, we cannot think today. But what you have to see is how much you have to allocate in what type of assets. That is what actually asset allocation is all about. That a particular, you go to an advisor, he can advise so much you keep it here because your age is growing. He rightly mentioned, sir, how many flats you hold. It is a trouble for the next generation. If you have 5 flats, the next generation will find it difficult to which to manage, whether to manage. If you give it as tangible assets, it is easier for them to work. So you have to look at that as an. So don't worry about the taxation. Taxation is something can change anytime. Sir, I think, I don't know whether I have addressed it.
Thank you, sir.
Yeah.
Unless I go for REIT, is that possible? I have to put 30 lakhs, 40 lakhs, and then get 2 crores. But in mutual funds, 1,000 rupees, 5 rupees is possible. That we have to take care. Most important.
What was your question?
You cannot do partial liquidation.
Yeah. What was? Regarding?
Yeah, will is essentially a document which where you can say that these are my assets and these assets have to go to A, B and C, that is all. It can be written on a plain piece of paper also, it's enough. You don't have to register also, that's also not required. On a simple plain sheet of paper you can write, I so and so am the owner of these assets. After my lifetime it will go to A, B, C, D. That A, B, C, D you can decide. Get it witnessed by your friend, you're good to go. I mean, not good to go, but good to go.
That's nice, sir. That's nice.
I have a question. In the age of digital influencers and people who post a lot of videos on YouTube, etc., each one have give their own advices, and we as young sisters look up to them and see what they tell and what they do. But personally, I am in lookout of a good advisor who I can meet offline instead of online, where it is for the masses. All the videos on YouTube and all the personal finance courses are on YouTube, and therefore masses, and I can't engage with them personally. Sir, they have introduced you as advisor who advises for high net worth individuals. But we as students and for the common people, how can we find a good advisor like you, and how is that possible?
I think by high net worth individuals, it doesn't mean that you're presently high net worth. You're a potential high net worth individual, right? So when you start and you end up with a corpus of 10 crores, you're going to be a high net worth individual. In this day of influencers, let me tell you very clearly, this is one of the most highly regulated industries in India. The amount of regulation that the mutual fund industry has, very few other industries have. So you need to ensure that the person you're seeking advice from is registered with SEBI in one form or the other. Whether an RIA or whether he's a distributor or whether you're dealing with a mutual fund directly, just ensure that it's a registered advisor. Only then you will get the right advice, and because he's trained, he's accountable, he's certifying, all those things are essential. Follow YouTube, follow Instagram, all that is fine. But the ultimate decision has to be taken by you. You are responsible, for which you need to discuss with somebody like you rightly mentioned. There are enough and more good advisors available to you whom you can discuss and start your investment journey. You don't have to worry about that. It's eminently possible.
So if you're looking for advice from a regulated person, there are three categories. I mean, you can go to a mutual fund distributor. The person will be registered with AMFI and he will have a number called ARN, AMFI registration number. So this person can actually distribute products to you, and he can do your execution of mutual fund transactions, etc. And he can give incidental advice to this. So the other category is called research analyst. Research analysts are allowed to give market views and views on fund categories, etc. But they are not supposed to give personal advice. So they can say that A, B, C are the best funds to buy in the flexi-cap category. But they cannot tell you that these funds are good for you, because research analysts are supposed to give generic recommendations. So on a website or newspaper, they can publish this and you can read it, right? So if you want personalized advice, you have to go to Registered Investment Advisor, RIA. These people take a fee, they look at your personal risk profile, and they give you advice which is suited to you. So these three categories exist, and all of them you have to verify in the SEBI website whether they are registered or not. Only then their advice is actually valid. If you are going to YouTube, etc., the problem is that some of them are genuine, but some of them are actually getting payments from the financial industry to actually promote the products. So they are advertisers and they are not advisors. Okay. Now, when you look at Amitabh Bachchan advertising Zandu Balm or something, that is not advice, right? That is an advertisement. So, many of the social media kind of advice that you get is actually promoted by some company or some product, and they are getting money from them. So, they are not giving you independent advice. So, you should be aware of that.
33 times the annual expenses will be your corpus fund, right? Okay, so it's 12 lakhs, assuming 1 lakh per month. So it is 12 lakhs into 33 times will come to approximately 4 crore.
Yeah.
So that is mismatching with the 10 crore what is talked about, which is correct.
No, that was a number based on what a projection was made for that particular individual in that particular case. So if your annual expenditure is going to be 12 lakhs, then for you 4 crores is adequate, is what he was saying. So it depends on person to person.
Okay.
My expenditure might be more, so I would have something else.
Thank you.
So how Ravi gave the 10 crore number was, he was assuming today you're 35 years old and 25 years later you're going to retire. Anna Madri, that was the assumption. So 25 years kapra, if you're retiring now, today's 1 lakh will become a much bigger sum, right? That is how he got 10 crore. Suppose you're already 60 and your expenses are 1 lakh, then you're 12 into 33. That will be the correct number for you.
Okay, okay.
Yeah. Correct. Yeah. Yeah. If you're already retiring, then correct. Yeah.
Because the panelists to throw some insights on AF. They're mentioning the alternative investment funds.
Okay, so AIF is a completely different beast, I would say. I'm using the word beast with very, very clear thoughts in my mind. the regulations are evolving as far as AIFs are concerned. AIFs are meant only for very well-informed investors who can take high risk. So it is not for a lay investor who is investing money for looking at some decent returns, because the investment carries a higher amount of risk than even any mutual fund scheme that is there. Secondly, the reason why there is a minimum corpus for investment in AIF is again because of the risk that is involved, and SEBI is very clear that only if you are able to take high risk and have a large amount of money can you come to AIF. So 1 crore is your threshold. Also, the taxation is evolving as far as AIFs are concerned. There are category 1, category 2, category 3 AIFs, which each have their own methods of investment. Different modalities are there, and the taxation is also different. Some is passed through, some is at source. So it's a little complicated beast. So unless you are willing for high risk, unless you have a corpus of more than 1 crore, unless you're prepared for volatility of returns or returns which may not happen, only then you need to look at AIFs. You have to be fully prepared and fully invested in the markets to understand what AIF can do for you.
I feel the corpus should be many times 1 crore because if you have just 1 crore and you're giving it to a single, AIF will be managed by one fund manager. So if you're giving it to a single fund manager, all your money, I really wouldn't advise that. So typically if you have 5 times 1 crore, maybe you can consider 1 crore.
Probably I'll be more conservative. If you have 10 crores, then probably 1 crore you can give to AIF.
Yes. Right, so I think we are out of time now. Thank you very much, and it was a very interactive session also. Thanks to Mr. Bhansali and Mr. Mittal also for very good insights.
வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு இன்றே வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்னதா இருந்தாலும் சரி, எஸ்ஐபி உங்க சிரிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும்.
வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்னதா இருந்தாலும் சரி, எஸ்ஐபி உங்க சிரிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் இன்றே உங்கள் முதல் எஸ்ஐபி தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC Mutual Fund இன் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி.
மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படி.
இது பிங்கியோட காலேஜ் டிகிரிக்காக. இது பிங்கியோட காலேஜ் டிகிரிக்காக. பாட்டியோட மருந்து செலவுக்காக. உங்க ஜீனியஸ் தம்பியோட லேப்டாப்காக. உங்க பிறக்க போற குழந்தையோட பொன்னான எதிர்காலத்துக்காக. நாளை உங்க சொந்த ரெஸ்டாரண்ட்டுக்காக. அப்புறம் உங்க ரிட்டையர்மெண்ட்காக. உங்களோட முதல் சொந்த கார்க்காக. பொண்ணோட கல்யாண ஏற்பாடுகள்ல எதுவும் கம்மியா இருக்க கூடாது. வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்காக.
வாழ்க்கையின் ஒவ்வொரு சின்ன பெரிய தேவைகளுக்கு நீங்கள் உருவாக்கும் கனவுகள் அது சின்னதா இருந்தாலும் சரி, ஒவ்வொரு நாளும் செபிக்கிறோம் உறுதியான நம்பிக்கையோட. செய்வது நீங்கள் தான், நாங்கள் வெறும் கைதான் கொடுக்கிறோம். எப்படி? எஸ்ஐபியுடன். எஸ்ஐபி அப்படின்னா சிஸ்டமேட்டிக் இன்வெஸ்ட்மெண்ட் பிளான். சிஸ்டமேட்டிக்னா நீங்க முதலில் இருந்தே சிறுக சிறுக சேமிக்கலாம். விதிகளுக்கு உட்பட்டு விரைவாக அல்லது தாமதமாக நம் ஒவ்வொரு கனவையும் நினைவாக்கும் இலக்கை நோக்கி கொண்டு செல்கிறது. நீங்கள் சிறுக சிறுக சேமிச்சத ஒரு சேமிப்பு பையில போட்டு வைங்க. அப்புறம் ஒவ்வொரு மாதமும் மியூச்சுவல் ஃபண்டோட எஸ்ஐபியில போடுங்க. எஸ்ஐபி உங்க சேமிப்பை உங்களுடைய வேலைக்காக செலுத்தும். உங்கள் ஒவ்வொரு கனவையும் அதன் இலக்கை நோக்கி இன்னும் சீக்கிரமாக கொண்டு செல்லும். ஏனென்றால் நாங்கள் உங்களிடம் தான் கற்றுக்கொண்டோம், ஒவ்வொரு துளியாக சேர்த்துதான் கடலை உருவாக்கலாம் என்றோம். இன்றே உங்கள் முதல் SCP தொடங்குங்கள். மேலும் விவரங்களுக்கு உங்கள் நிதி ஆலோசகரை அணுகுங்கள். LIC மியூச்சுவல் ஃபண்டின் இன்வெஸ்டர் எஜுகேஷனுக்கான ஒரு முயற்சி. மியூச்சுவல் ஃபண்ட் முதலீடுகள் சந்தை அபாயத்திற்கு உட்பட்டவை. திட்டம் தொடர்பான அனைத்து ஆவணங்களையும் கவனமாக படிக்கவும்.